Yesterday, I saw a very large influencer on a very big podcast talk about some of the worst real estate investing advice I have ever heard. This happens to be not in the residential space, it is in the commercial space. So I thought I would share it with somebody who plays that game more than I do and see if I'm just crazy and maybe it is solid advice. We're going to do this with Anna Kelly. How you doing, Anna?
I'm doing great. Always interesting to hear what people say, right? Especially when it's crazy and not good.
Yeah. Well, again, I don't know. Maybe this individual is right, but I thought I would share it with you. I haven't given you a preview, so you're going to react to this in real time. You ready?
I'm ready.
So basically, this individual plays in the multifamily space, the big stuff, the syndicator space, right? Not the little, fourplexes, fiveplex. This is the 100, 150, 200 unit, 400 unit space.
Sure.
And basically, they were on the couch talking to a big podcaster saying, President Trump wants lower rates. He wants the Fed to lower rates 350 basis points. He wants the Fed funds rate to be 1.5%, not zero, but 1.5, dramatically lower than where we are today. And to net it all out, this guru, who I'm guessing is in a lot of pain, but maybe not, but I'm guessing, is basically telling people buy now and refi in a year. And that sounds an awful lot like marry the house, date the rate, which burned people in the residential space. But now you're doing on an asset with a lot more zeros. That might be some of the stupidest advice I have ever heard. But again, it's a world I don't play in, so maybe I just don't get it. What do you think?
Michael, did they not live through the last 2.5 years of commercial real estate tanking 30 to 40%? Like, either they're new and they're just on stage and someone's calling them a guru.
I think it's worse. I think they
learned the lesson.
Yeah, that's the one. That's so the key is,
and it's probably somebody I know because I've spoken on a lot of stage with multifamily.
I'll tell you offline who it is, but yeah, I think it is somebody you know.
Yeah, I would say I definitely disagree. And there's a couple of important reasons. Number one, for those that are in the residential and don't really know, commercial real estate's valued very, very differently than residential. It's really valued based on where interest rates are, because what investors of commercial real estate are trying to do is they're trying to make a return on their money that's better than what they can get in a U.S. Treasury. And historically, that spread has been 230 basis points. So if the federal funds rate was 3, then to buy a brand new Class A multifamily building with all the headaches that comes with construction and all the risks of whether I can fill them, et cetera, I'd want a 5.3% return on my money. And so we call that a cap rate, the market rate. What's the comp? Well, if you want to buy or sell, you better make 5.3% if you paid all cash. And then if you want more than 5.3, you go do things like you buy bonds, or you go invest in the stock market and hope for your 7 or 8% return with a little more risk as you move up that ladder. So Michael, if you think about the fact that Treasury rates went up substantially, what happened to commercial real estate was just to jump from, a Treasury of 3 to a Treasury of 5 would make investors demand 7.3% return on their money. That makes the market cap rate go to 7.3. So if someone wants to make 7.3 on their money instead of 5.3 on their money and pay cash for the same income coming in, what do they have to do? They have to buy it at a lower price. So values fall commensurate generally with the amount that U.S. Treasury rates go up. So when interest rates are up, technically values should fall. So in this person's thinking, they're saying, well, if the Fed cuts rates, then values will go back up. But here's the thing that they're missing, Michael, because there's always, it's much more complicated than the nuance that we want to say.
Yeah.
Part of why values have fallen is because interest rates have gone up, as I've just said. But generally, that spread, general, what should investors demand on their money for the risk inherent in buying the asset? It should have stayed about 230 basis points. So Class A multifamily should be trading at a 7 or 8% cap rate. But what's happening? Investors are not buying. They're not, sellers aren't selling unless they're desperate and they went into foreclosure. But investors are kind of saying, we're not buying at all. And so there's not a lot of comps to even know what the cap rates are. But what's interesting is although they should be much higher, and part of why I have sat on the sidelines by and large for the last 2 years with large multifamily is because I couldn't get a return in that 8% range, 10 or 12 if I'm looking at B or C. And if I can't get that risk adjusted return, then I'm taking too much risk just to keep playing the game for returns that aren't paying me commensurate with the risk that I'm taking. And so the reality is, where are cap rates today on those things that are trading? They're still in like the 5.2 to 5% range, but very few are actually buying them, only really big REITs. And so if this investor, this guru who was sitting on the couch, were to look at the fact that cap rates didn't go way high for Class A because things are just not trading, but they're staying way lower than they should, then the question is, are they really going to continue to fall from here just because rates come down? I would argue no, they probably aren't, because it takes time. If they had adjusted, then yes, then when rates come back down, values will rise. But they haven't adjusted. And that is the key that they are missing, is when rates, if let's say the Fed did cut and the treasury rate went back to 2, let's say that we got a US treasury rate of 2, then a brand new Class A would trade at a 4.3 cap. Okay.
Yep.
A 4.3 cap. So a Class B is going to be at a 5.2 to 6 cap, somewhere in there. Most syndicators are buying C stuff, maybe B, maybe C. So if they're going to buy today at a 5.25 and think that their cap rate is going to go to a 3 or a 4 where A stuff was, they're smoking hopium, at best. And so it is really a short-sighted recommendation. It's a really bad recommendation.
It's horrible advice.
Cap rates, because of the volatility and the uncertainty and the time that it takes for banks to even offer lower interest rates once the Fed does lower rates, it could take a year or 2 for things to just stabilize, to even know where price discovery is and where that cap rate is. If you think you're going to get in now and refi in a year, you're going to be stuck and you're going to lose your property, just like all these people that did short-term bridge debt for 2 years and can't get out of them now and are going into foreclosure. Like, you would be repeating the same stupid mistake, but now you should have the foresight to know this doesn't end well. To make that mistake now would be like egregious. It's like, mess up once, shame on me. Mess up twice, or mess up once, okay, shame on you. Mess up twice, shame on me. It's like, here's your sign. It's the worst possible thing you could do.
I think there's so much
indicator.
Yeah, I think there's so much. And again, my guess of this situation, I don't know. Again, this is not a world I play in, but it's when I see advice like this that is so dangerous, it just annoys me. My guess is this individual actually did live through the last 3 or 4 years. And I think they're actually in so much pain. They're kind of trying to pull out a Hail Mary and trying to save or create the volume. Because I think you pointed at a couple of things that are absolutely right. Is we just haven't had the deal activity. And another way of saying that is no price discovery.
90% reduction in commercial real estate transactions in 2 years. 90%.
Yeah, no price discovery. And if you don't have price discovery, you don't really know what the cap rate is. Right. You may be artificially looking at a cap rate of 5.3, but that's only because the best of the best, and you had a couple of BlackRock or Blackstone, hedge funds buy shit for cash. That's not a normal market, right? If they're the only people in the market, that's not it. So I think we haven't had price discovery. I think a lot of people are in pain. I think there's more people in pain in this part of the market than most people realize. And I think some of the pain is really bad. And they're just hoping that, the Fed bails them out. It's not coming. Because the other thing you didn't talk about, but is equally valuable, having watched multiple cycles, we saw so much cap rate compression last time where C and B were trading almost like A. That stuff has to explode the other way. We have to have regression to the mean. And the gap, if the gap was 1, it's going to be 2 or 2.5.
Yeah.
As we get out of this.
Stuff was trading within like half a point of Class A stuff. And it should have been at least 2%. So, people that have gotten in the space in the last couple of years before all this happened only saw great stuff. And so, they saw great followed by bad, and they think that the great was the norm. And unfortunately, the great wasn't the norm. It was the anomaly. And even though, I got into the larger multifamily stuff in 2018, I had been investing in real estate since 1999, so I had almost 20 years in real estate and understanding the fundamentals. But a lot of syndicators actually went to big conferences. They had never been in real estate. They were sold, hey, jump straight into the 100 unit. It's just as easy as the 4, which it wasn't. And a lot of new syndicators got stuck, and a lot of experienced syndicators did as well, because we didn't realize, hey, things won't continue the way that they are necessarily, or nobody could have predicted the pandemic and the inflation and how bad it would be. But also, people really underestimated, myself included, how long it could take to kill this inflation monster and how long rates could stay high. And because of that, how many people would lose properties. And people aren't talking about it, but so many of our lost properties. And there's a whole lot more, Michael, as the banks are finally saying, we can't let you extend and pretend. There are a whole lot more that are going to fail and go under. And then at that point, I'll give this guy some props, right? One, there's always opportunity. There's always deals out there, right? So if you happen to be able to get your hands on a deal that foreclosed, that makes sense where it cash flows today at a good risk-adjusted return and cap rate, and that you can hold on to that deal and make it cash flow, even if you can't refi, and you put on long-term financing, then yes, this could be an incredible time to buy a deal that was poorly managed, that was overpriced. You're now getting it for a good price. You're getting a good cap rate, let's say a 7 cap at least, on it, something in decent shape, hopefully a lot higher cap. Then yes, this could be a great time. Lock in your rate. Don't float. That would be ridiculously stupid. Lock in your rate with a decent prepay penalty that isn't going to kill you on the way out if rates do fall. And then if rates do go down and cap rates actually adjust on that property, more so because of what you're doing to make it a better property, then great, do the deal. But if the average person hears that, Michael, you're literally about to send them into the poorhouse for the rest of their lives.
No, I agree. Again, I think Ken McElroy said it best. He thinks we're in the 3rd inning of this. And again, if you don't know baseball, there's 9 innings. So we got a long way to go in this and lots of pain to still come. Again, banks are just starting to wake up. They can't extend and pretend forever. So pain is coming. Opportunity is coming. But again, I think betting on rates going lower and cap rates collapsing to bail you out is horrible advice. And I just wanted to make sure I was on the right page. Anna, where can people find you?
Especially if we go into a recession. Because the other piece that we didn't talk about here is that not only are you dealing with the cap rate issue,
NOI,
you're also in an environment where taxes are going up, insurance is going up, rents are not keeping up with expectations. People are starting to default and not able to pay rent and move in with parents again. And so, you still have challenges on the income side that you have to deal with. And if we go into a recession, guess what banks will do? They'll lend even less. So part of why transactions are dried up is because the banks can't lend on the commercial stuff because they don't know where cap rates are going to go. So I think this could take to the point of, Ken saying the 3rd inning. You go into a recession and banks start really tightening up more so than they have. You're looking at 2 to 3 years out before banks are going to refi or give your buyer that you want to exit and sell to the kind of loan that they need to make the deal work. So just be very, very, very careful. Anything you buy today, whether it's, commercial or residential, generally should be long-term holds with good long-term debt. And if the deal works the way you're doing it and you're not relying on that upside and rates falling, great, continue to do deals. There's lots of opportunity, but don't listen to guys that are doing a podcast on a couch that clearly are not
don't have your best interest in mind.
And have your best interest at heart.
Where can they find you?
You can find me here on your show most weeks. You can find me at Anna Kelly Investing for Real Estate Wealth and Real Estate Coaching. And you can find me on social media at Anna Kelly REI Mom.
Thank you so much. Have a great week.
You too.